Hi guys, good afternoon. Can I confirm my audibility? Am I audible? All right. How's your preparation going? Well in control? Can I just get a quick update? Right. How many actually following the study planner? The 30-day study planner? Right. So we have two of you using the study planner. Okay, that's brilliant, Asya. Right. The rest of you, I hope you all have created your own study planners and following that. At this point, you're supposed to follow something. All right. Okay, so starting off with or continuing with where we left last week. Last week we discussed 25 MCQ questions, and today we are starting off with 26th. So just like last week, I'd be giving you all time to do the questions, then we discuss. So we're doing the questions in batches again this time as well. So 10 questions, discuss, 10 questions, discuss, 5 questions, discuss. So that's the plan. And then, if time permits, we'll look at a section C question as well. So 105 is where we are supposed to start today. So 105, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 127, until question 127. So go ahead, do until question 127, then we'll discuss. All right. So it's going to be 10 questions carrying 20 marks. So that translates to around 36 minutes. But I'd be giving you 30 minutes to do attempt it, then we'll discuss. Okay, so it's 137, let's say 140. So let's start the discussion at 210. All right, go ahead. I hope all of you have access to uh, the Power 40 questions. Anyone who does not have access, please drop me a text. I'll share the questions with you. Is it? Okay, so let's make your Power 50. It's not Power 4, it's Power 50. So two more questions extra. So fine, let's discuss those as well in the third batch. Yeah, 10, 10, 7. All right, go ahead. Hello. Doing the exam this time, right? Okay. So actually, I've given time for you all to do 10 questions. So we're starting discussion at 2:10. Actually, I have sent a PDF on the group, or you received the PDF, right? Power 50. Yeah, the questions that we were discussing last week. So in that, we start from 105. We do 10 questions. It's just 5 more minutes. I hope you are done. Yeah. No. Why is that? Right. Okay. Studying, right? Preparation ongoing. Preparation going on. Following a study planner or following the study planner or following your own?
Finish the syllabus only, I come to the I have my guts, I can do.
For sure. Well, failing FR is the toughest thing in ACCA, because you'll get through FR if you like properly put your efforts and you study well. So don't worry there. Okay. All right. Question number 5. Question number 5 says, on 1st January 2023, Bert Rand issued 20 million convertible loan notes. Okay, when that's brought in, we know it's financial instrument, compound instrument, meaning it is going to have the compound instruments. It will have two components, equity and liability. Okay, so liability component is going to be the present value of future cash flows discounted using effective interest rate, and the cash flow for that you'll be using the coupon rate. Okay, and then this is going to be the balancing figure. Okay, when you see the question, this should come to your mind.
The coupon rate, we see the interest must use the effective rate.
Yes.
Then only the discount will start.
So in discounting, when you're discounting, we are using the effective interest rate. Cash flows, we are using the coupon rate. Why? Because cash flows is what you receive or what you pay. Now let's say you have an interest amount. So based on effective interest rate, you have let's say 10% effective interest rate. So you have 10,000. So how much is going to be your interest? It's going to be 1,000, right? That's your effective interest. But let's say out of which the coupon rate is 8%, meaning you will be paying only 8% every year. So that's going to be 8% of 10,000, which is 800. So 200 will be carrying forward and will be settling towards the end of the period when you are exhausting the liability. Okay? Right. All right. So when you look at that question, that should come to your mind first. Carry a coupon rate of 6%. So the coupon rate is 6%. The loan notes are redeemable on 31st December at par for cash or can be exchanged for equity shares. A similar loan note without conversion option would have required Bernard to pay an interest rate of 9%. This is effective interest rate. Okay? Effective meaning market rate. Without an optional coupon rate, any other interest rate is what will be your effective interest rate. So to discount, you'll be using this. And for cash flow, you'll use 6%. Okay? So it's 20 million. Then the present value of $1 receivable at the end of each year based on discount rates are given below. So how much would be recorded in equity in relation to the loan notes? Now let's open Excel here. Okay. 20x3, right? So 1st Jan 20x3. So first year is going to be 20x4. 3 years, so 20x4. x5, x6. Right. What's going to be the cash flow? Tell me. Cash flow. Cash flow is going to be 6% into 20. That's going to be your cash flow. That's 1,200. So that's the interest that you'll be paying, outflow every year. What's other cash flow? On year 3, there is going to be an outflow of principal amount as well. Why? Because at the end of year 3, you are supposed to settle the principal amount. So you'll be paying principal amount as well. So what's the principal amount? 20 million. That's going to be this plus 20. That's the cash flow for year 3. Then we have the discounting factor. We use discounting factor of the effective interest rate 9%. So to discount it, we know they've given the discount rates, right? 0.92 on year 1, 0.84 year 2, and 0.77 year 3. Effective rate. That cash flow should be coupon rate. Multiply by. Right, so what's the total? 18,436. So what's going to be your equity? 20,000 is the total, so equity is going to be the balancing figure, which is this minus this. This is your liability. This is your equity. So what are they asking? How much would be recorded in equity in relation to the loan note? So we know it's going to be 1564. Okay, so we're going to record it as 1564,000. 1,000 they've already given, so you have to just put 1564. How many of you got it right? Quickly raise your hands. Raise your hands if you got it right. Right, 3 of you. The rest of you, okay, 4, 5, 6. Okay. The rest of you, where did y'all go wrong? Any point that y'all went wrong? I hope it's clear now. Yeah? Right. Next question, again, financial instruments. One day issued 20 million, 5% loan notes on 1st January 2009, incurring issue cost of 600,000. The loan notes are redeemable at a premium, giving them an effective interest rate of 7%. What expense should be recorded in relation to the loan notes for the year ended 31st December? All the financial assets and financial liabilities, initial recognition is going to be by capitalizing transaction cost, unless the subsequent measurement is using fair value through profit or loss. Okay, that's the theory. So what happens here? You are supposed to capitalize the 600,000 transaction cost. So when it's a liability capitalization, meaning reducing the liability, asset capitalization means adding to your asset. So the answer is going to be 20,000 minus 600. That is going to be your initial liability, right? And based on your initial liability, there is going to be interest. Expense should be recorded in relation to the loan notes for the year ended. They're asking what's the interest, so that we know it is this into effective interest rate of 7%. So the answer is 1358.
Then we won't multiply based on the coupon rate.
No, that's going to be for cash flow. So again, let me reiterate on that table. If you just go and watch the financial instruments lecture, they're making things very clear. So there we have opening liability, then we have finance cost, then we have interest paid, then we have closing liability. This interest paid is going to be based on coupon rate. Finance cost is going to be based on effective interest rate, because this is what tells you what's your actual expense. This tells you how much you're paying out of that, right? And balance you carry forward until you exhaust your liability. At that point you settle it. Okay,
although we are paying in a coupon rate, in the P&L we must put the effective rate.
Effective rate. Okay, this coupon rate is going to be a part of a cash flow statement, yeah, where you show the interest paid component. Okay, right. How many of you got it right? 1358. Okay, 4 of you. Right, so let's move on to the next question. Now we are moving into IAS 12. Now we are done with financial instruments. We discussed some really good questions there. Now we are moving into IAS 12, taxation. Okay. Hudson has the following balances included on its trial balance at 30th June 2024. Taxation 4,000, deferred tax 12,000. Taxation balance relates to an over provision from 30th June 2023. Over provision, when it's over provision, what do? We deduct from our income tax expense. Under provision, we add to our income tax expense, right? At 30th June, the director estimated that provision necessary for taxation on current year profits is 15,000. So 15,000 is where you are going to so there it's over provision. So you're going to deduct 4,000. Okay, 15,000 minus 4,000, number one. So we can go figure out what's going to be the first deduction. The carrying amount of Hudson's non-current assets exceeds the tax written down value by 30,000. Tax rate of is 30%. Right now they have given us the deferred taxation at the year end. So what's that? Equals 30,000 into 30%. So that's 9,000. So what happened? It's 9,000. I mean 12,000, that became 9,000. So is there a reduction or an increase? So it was 12,000 as the opening deferred tax given here, right? They've given it here, there it is 12,000, right? So 9,000 as per the calculation as a closing date. So it has reduced. When it has reduced, what do? When the deferred tax increases, income tax expense increases. When deferred tax reduces, income tax expense reduces. Okay. So here they are asking what is the charge for taxation that will appear in the statement of profit or loss. That's going to be equals 15,000 minus 4,000 minus 3,000. That's 8,000. Okay. So what's the option? C. How many of you got that right? I want all of you to raise your hand if you have got it right. I'm just evaluating how many are getting right. Okay, 4, 5, okay, 6, 7. 7 of you. Yeah. Yes, Shakil, tell me. Shakil, until you type, let's proceed to the next question. Holmes has the following balances included on its trial balance at 30th June 2024. Taxation 7,000, deferred taxation 16,000. Taxation balance relates to an over provision. Again, you have to deduct that. At 30th June, yeah, so that we remove off from the SPL and we charge it from the other comprehensive income. Okay, that's what we are discussing now. After we discuss, we'll discuss that. So, directly estimate that the provision necessary for taxation on current year profits is 12,000. Okay, that's a current tax. The balance on deferred tax account needs to be increased to 23,000, which includes the impact of the increase in property valuation below. So what has happened? 16,000. Now from this indication we know 16,000 has become 23,000. But there is a catch. They are saying there is a property valuation below. So when there is a property valuation as per IAS 16, where does the gain go? Revaluation gain, where does it go? Other comprehensive income. Okay, revaluation other comprehensive income. So when revaluation gain goes to other comprehensive income, any deferred tax that's relevant to revaluation gain also goes to other comprehensive income and not P&L. Why? When you're presenting the income from other comprehensive income, is it right to show the expense in the P&L? No, the presentation, there's no fair presentation. So wherever you are showing the income, the matching concept, the income, that's where the deduction also should be. So revaluation gain causing an expense that should be deducted from other comprehensive income. So gain of 10,000, the rate of 30%. So 10,000 into 30%. That's 3,000. Okay. Now from this, you have to remove this amount, right? From the 23,000, whatever the chain difference that's coming in, you have to remove the 3,000. Okay. So that's going to be 7,000. So we have the over provision of 7,000 right? So 7,000 over provision. So that's going to be a part of your SPL. Then what's the difference between the 23,000 and 16,000? That's all 7,000. But from that, we have to deduct 3,000. So that's going to be how much? 4,000. Now what do? 4,000. It increases by 4,000. So your income tax charge also will increase, right? So this is being deducted minus 7,000 and you add this 4,000. To what amount? 12,000. So what's the total? 9,000. What is the charge for taxes? They'll appear in the statement of profit or loss. They're being very specific, so that's going to be 9,000. If they ask you what's appearing in other comprehensive income, there you should say it's going to be 3,000. Okay? The answer is A. How many of you got this right? Yes, Shakil. So revaluation gain we show as 10,000 minus deferred tax. So net gain will be 7,000. That's good. Okay. Okay. So we have 3 of you. The rest of you, what's happening? Are you not getting it right or what's that? All right. Okay, so now we are moving into the next question. Coral Co has net profit, so this is earnings per share. So now we are done with IAS 12. We're moving into IAS. Yes, Shakil.
That's the total for profit or loss, right?
Yes, 9,000.
If it's only the tax amount, we should deduct that 3,000 from here, right?
Sorry?
And the 3,000 we need to put it after the other comprehensive income.
Other comprehensive 3,000 will be shown like this: revaluation gain. You'll have 10,000. Then deferred tax on revaluation gain is going to be minus 3,000. Net gain will be total other comprehensive income. This is the other comprehensive part. Okay, is that clear?
The tax part then without that.
Tax is going to be this. This is the current year income tax estimate. This is the over provision. And this is the deferred tax increase by eliminating OCI component. Clear?
Yes.
Right. Now we are moving to IAS 33. Coral Co has net profit for the year ended 30th September of 10/5. Coral has had 6 million shares in issue for many years. Sorry. On 1st October 2024, Coral issued a convertible bond. Now what happens there is when convertible bonds or share options is used in earnings per share, you should know there is going to be a dilution. So you have to show diluted earnings per share as well. Okay. Right. So it had an initial liability element of 2.5 million and the market interest rate for non-convertible instruments is 8%. The bond is convertible in 5 years with 50 shares issued for every 100 nominal of convertible bond held. Coral Co pays tax at a rate of 28%. What's the diluted earnings per share formula? Earnings plus notional extra earnings divided by number of shares plus notional extra number of shares. Is that clear? Can this be, do you all remember this? There's notional extra number of shares, right? That's for convertible loan note, right? Now what's the earning they've given? They've given the earning as 10.5. What's the notional extra earning? Notional extra earning is going to be as if this loan note has been converted to equity. When you had converted that, what happens? When the loan note was not converted, it was a loan note, it was a liability. When there was a liability, you pay interest on that. When you pay interest on that, the interest reduces your profit. And the profit is what is taxed, therefore you have reduced the reduction of taxation there, right? So you have to imagine as if you have, the whatever the translation or whatever the conversion is to happen has happened. When that happens, loan, there's no more loan, meaning there is no more interest. When there's no more interest, meaning the interest is saved. When the interest is saved, there is going to be tax on that extra interest. Why? That's an earning. That's going to increase your profit. When your profit increases, there's extra tax on that. So that tax reduces your extra earning, and that is what is going to be your notional extra earnings. Okay? Right. So what is the interest saved? Interest saved is how much? 2.5 million into 8%, right? What's the tax rate? 28% is the tax rate. So what is the tax on this interest saved? Tax on interest saved. That's going to be this into 28%. That's 56, right? So what will be the notional extra earning? 200 minus 56. So that makes it in total 10,500 plus 144. That's 10,644. That's going to be your numerator earnings. Okay, right. Then comes the number of shares. So what were the number of shares? Shares before conversion. How many shares are they saying? 6 million shares, right? 6 million shares are already there is what they're saying, right? Now, when the conversion happens, they are saying convert, it had initial. So how much is it convertible? 50 shares for every 100 nominal of convertible bond held. Meaning for every $100 of 2.5, you will be getting 50 shares. Okay, so how do you do that? Notional extra shares, that is 500 minus half. For every 100, you are getting 50 shares, is what they say. That's 1,250. So what's the total number of shares? Total shares. That's 7,250. So what will be your DEPS? That's going to be earnings divided by shares. So how much is that? How much is that? B. Okay. D. 146.8. Right. So always you show it in cents. Okay. 146.8 cents. Are we clear? How many of you have got it right? How many of you have got this right? Four of you. What happened to the rest of you? Right. So rest of you, can you all tell me where are you struggling? If there are any areas you are struggling, let me know, because these are sessions where you all can clarify all your doubts, and wherever you are struggling, you can get that clarified. Okay. Don't just sit and relax and ask questions. Okay. Right. Next question. ISCO's financial statements show a profit for the year to 31st December 20x5 of 2 million. On 1st January 20x5, ISCO had 4 million shares in issue and made no further issues of shares during the year. At 31st December, there were 1 million outstanding options to buy shares at $3 each for the year to 31st December 20x5. The average market value of ISCO share was $5. Now what happens here? What happens here? There is share options. Again, this is going to lead to diluted earnings per share. Okay, when this leads to diluted earnings per share, we know that we have to identify the free component of share. Right? Why? The share option, the value of share ISCO share was 5, but you are getting it for $3, meaning the $2 is like the benefit that you're enjoying, right? 2 is the benefit you're enjoying, right? So you need to convert and look at what's the number of free shares that you have. Okay, right. Now what are they saying? It's going to be $3 per share into 1 million. $3 into 1 million. So what's going to be the total price of share options that they can purchase? They can purchase 1 million shares by paying $3 million. At the market rate, how many shares can they get for $3 million? Tell me. They can get only 600, meaning the extra, the difference between the 600 and the 1000, because they can get only 600 at 3 million at market rate, but they've got 1000 here, or 1 million rather. So when they are getting more, meaning they've got extra shares, which is 1000 minus 600, that is 400. So diluted earnings per share will be the earnings of 2 million divided by the number of shares in issue plus the free shares that you are getting. Okay, so what's going to be the answer? $2 million divided by 4 million plus 400. It's 2 million, right? Yeah. The earnings divided by shares, that's 45.5 cents. C is the answer. How many of you got this right? Yes, we can use that equation also, Shakil. We've discussed in the class there are two ways of arriving at this, so you can use the equation as well. Okay, by using the equation also you arrive at the same 400. Okay, right. Great. Are we done with 10 questions? 2, 3, 4, 5, 6, 7, 8, 9, 10. This is the 10th question. Right. Now we are moving into consolidation. Gromit Co has the following extract from its consolidated profit or loss account. Profit for the period 2.8. Other comprehensive income revaluation gain of 500. Profit for the period attributable to parent 2250. Non-controlling interest 550. Total comprehensive income to parent 2.6 and non-controlling interest 700. What figure should be used as earnings by Gromit in its earnings per share calculation? Now this is Gromit. So what figure will Gromit use for earnings per share? It's the profit attributable to parent. Very straightforward question. The answer is 2250. Okay, the answer is 2250. Still we are in earnings per share itself. Okay. The next question again, it's earnings per share. On 1st October, Hoy had 2.5 million of equity shares of 50 cents each in issue. No new shares were issued during the year ended 30th September, but on that day, there were outstanding share options to purchase 2 million equity shares at 1.20 each. The average market value of Hoy's equity shares during the year was $3 per share. Hoy's profit after tax for the year ended was 1.550. Right. 2 million at 1.2 each equals 2 million into 1.2 each is $2.4 million. If we convert this into the market rate of 3, you can get 800 shares. So how many shares are you getting? How many shares are you getting here? You are getting 2 million. So 2 million minus 800 is going to be a free shares. That's 1.2. Right. So we have 2.5 million shares, 2.5 million dollars of equity shares, each worth 0.5. So that's 500 or 5 million shares, right? 5 million shares. Okay. Into 0.5 into 0.5. It's 1250. So 1250. Okay. So 1550 is your earning. Okay. 1550 is your earning. So 1550 being your earning, number of shares that you have, 2.5 million of equity shares, 50 cents each. Small confusion. So this is to be divided, right? Earnings divided by this plus this 0.25. That's 25 cents. Okay. That's $2.5 million of equity shares of 50 cents each. So divide it. Okay. Right. Are we clear? Are we clear with DEPS, diluted earnings per share? Right. Then we are moving into IAS 37. Target is preparing its financial statements for the year ended 30th September 2027. Target is facing a number of legal claims from its customers with regards to a faulty product sold. The total amount being claimed is 3.5 million. Target's lawyers say that customers have an 80% chance of being successful. If customers have 80% of chance of being successful, meaning Target has 80% chance of failing. When 80% chance of failing, that is a provision, right? According to IAS 37, what amount should be recognized in respect of Target statement of financial position? Straightforward, 3.5 million. Okay, clear? Right. Then we move to the next question, which is 127. ABC has a year end of 31st December 2024. On 15th December 2024, the directors publicly announced a decision to close an operating unit and make a number of employees redundant. Some of the employees currently working in the unit will be transferred to other operating units within ABC. The estimated costs of the closure are as follows. Right. So they've given the estimated closure cost. There is redundancy cost, lease termination cost, relocation of continuing employees, retraining of continuing employees. Right. So as per IAS 37's restructuring cost, retraining and relocation will not be provided for. As a restructuring provision or closure provision, it is going to be the redundancy and lease termination cost only. That's 1 million. You never recognize a provision for relocation or retraining because that's a part of continuing of the employment. Okay, so you recognize all the other termination related or closure related provisions only. Are we clear? Are we clear? Yeah. Right. So now you can proceed from 128. Do the 10 questions, then we discuss. That's going to be from 128 to 2, 3, 4, 5, 6, 7, 8, 10. Do up to 162. Then we'll discuss it. Okay. Again, take 30 minutes and do the questions. It's 2:45. We'll start discussion at 3:15. All right, guys, shall we start the discussion? Okay, starting off with question 128, continuing with IAS 37. On 1st October 2023, Explorer commenced drilling for oil in an undersea oil field. The extraction of oil causes damage to the seabed, which has a restorative cost, ignore discounting, of 10,000 per million barrels of oil extracted. Explorer extracted 250 million barrels of oil in the year ended 30th September 2024. 10,000 into 250. How much is that? 2.5 million, right? That's 2.5 million. Then Explorer is also required to dismantle the drilling equipment at the end of its 5-year lease. This has an estimated cost of 30 million on 30th September 2028. Explorer's cost of capital is 8% per annum and $1 has a present value of 68 cents in 5 years' time. Right, 30 million's present value calculation. So that's going to be 30 million, or let's say do it in thousands, into 0.68, right? So how much is that? 30,000 into 0.68, how much is that? Quickly do the math and tell me. 20,400, right? Now this was done on 30th. So 1st of October is when they've started, and 30th September 2024 is where they're asking it, right? For the year end, right? So what happens with this at the year end? It becomes 30 million in 5 years' time. So what happens at the end of year 1? Unwinding. Whenever there is a finance, whenever there's a discounting happening, there's unwinding that happens every year. Unwinding happens at the interest rate. So that's going to be 20,400 into 8%. How much is that? How much is 20,400 into 8%? 1,632. Tell me what's the total? 20,400 plus 1,632. What's the total? 22,032. Right. So 2.5 million plus 2.2 million. 2.2032. How much is that? 24,532,000. Okay. The answer is 24,532,000. Okay. Is that clear? So provisions, dismantling, extraction. So extraction, we knew exactly what was the cost. So there they asked to ignore discounting. Had they asked to consider discounting, we should have considered discounting there. Okay. All right. 135. The following information is available for property plant equipment of Fry as at 30th September 20x1, 20x3. Both are given here. What amount would be shown in Fry's statement of cash flows of purchase of property plant equipment? This is IAS 7. Right, so we're moving to IAS 7. Okay. Right. So here we have to always work with T accounts. When it comes to cash flows, we have to work with T accounts where we get the opening balance, closing balance, then whatever increases that item, we take it into the respective debits or credits. So we should know the double entries clearly. Okay. All right. PPE. Right. So this is the debit side. This is the credit side. Okay. All right. Opening 20x3 is 14,400 brought forward. Value is 14,400. Right. Carried forward 23,400. Right. Okay. Depreciation reduces the PP amount. So depreciation should go to the credit side. Anything that increases the PPE goes to debit, reduces goes to credit. Depreciation of 2.5 million. Item of plant with a carrying amount of 3 million was sold for 1.8 million. Carrying amount was 3 million, so we have to reduce the carrying amount here. Disposal. So our PP reduces by the carrying amount. Why? It's accumulated depreciation where they calculate the total depreciation carried forward. But cost will show the carrying amount itself. So we remove the carrying amount. Okay, so disposal carrying amount 3,000. Then a property was revalued upwards by 2 million. Okay, revaluing upward of property is going to increase the property price. So revaluation gain. Okay, that increases the property price by 2 million. Environmental provision of 4 million related to property, plant, and equipment were capitalized. Capitalized meaning increased provision. It increased the amount. It increased the PP value. That's 4 million. Okay. $2,400 is the total. So what's the difference? 2,400 is the value here. What's the total here? What's the total here? It's going to be what's the difference? There is a difference, right? This side is lower, meaning there is addition. So that's what they're asking. What amount would be shown as purchase? 8,500. Now this balances. Okay, now it balances. Are we clear? So the answer for this question is going to be this. Right. How many of you got this right? How many of you got that right? Very good. Okay. Then moving on to the next question. Again, it's cash flow that they are, they are checking. So again, this is a cash flow question, IS 7. At 1st October 2024, BK had accrued interest payable of 12,000. During the year ended 30th September 2025, BK charged finance cost of 41,000 to its statement of profit or loss, including unwinding a discount relating to a provision stated at its present value of 150,000. At 1st October 2024, the closing balance on accrued interest payable account at 30th September was 15,000 and BK has a discount rate of 6%. Accrued interest payable. So you can use T account, or here you can use plus or minuses also. There are two ways: reconciliation method, T account. So we use T account method there. So let's try to use the plus or minus. Or let's use the T account itself. I mean, that's more convenient. Accrued interest payable. So anything that's payable will be, the opening balance will be what? That's going to be how much? 1st October 2024, that's the opening one. Brought forward is 12. Charge finance cost in statement of profit or loss of 41,000. Charge increases the interest, right? Interest expense 41,000. Okay, this includes unwinding of a discount rate in a provision to present value of 150,000. Okay, now this is not a cash item, right? So this we have to eliminate. Okay, this figure we have to remove. Okay, because that this is included here now. So we have to take the, so it's 41,000 to its statement, including unwinding discount rate in a provision stated at its present value of 150,000. Okay, B has a discount rate of 6%. So how much are we going to remove? 150,000 into 150,000 into 6%. Right? So that's the amount that you are reducing. Okay, so the 41,000 includes that. So you're removing that because that's not an item to be considered for cash flow. Right? Cash flow requires cash items only. Right. Closing balance is 15,000. Closing balance carried forward is 15,000. Okay. Now tell me what's going to be the total. So there is a difference of 29,000. Okay, so interest paid reduces your interest payable. Why? You already paid it. So it's no more payable. Interest paid is going to be 29,000 here. Let's see whether it balances. There we go. The answer is B, 29,000. How many of you have got this right? Right, great. Okay. Next question. Butcher had the following balances in its statement of financial position as of 30th June 20x0 and 20x1. Share capital 20x0 150 becomes 170. Share premium 95 becomes 105. Right. So what happens here? Share capital is increased, share premium is increased, meaning share issue has happened there. Right. So by how much? This has increased by 20. This has increased by 10. Right. Then debentures 190 becomes 170. So reduces by how much? 20. So what's going to be the net cash flows from financing activities? 10,000. That's the answer. Okay, that's the answer. Next question. At 1st January, KC had property plant equipment with a carrying amount of 180,000. In the year ended, KC disposed of assets with a carrying amount of 60,000 for 50,000. KC revalued building from 75 to 100 and charged depreciation for the year 20,000 at the end of the year. The carrying amount of PPE was 250,000. Right. Now what happens? They are saying there is a sales that has happened. Okay. So they are asking net cash flows from investing activities. Okay. So what happens here? 180,000 was your, now we are doing the reconciliation method. 180,000 was the opening figure. Right. Disposal of asset 60,000. You deduct the carrying amount. Then revaluation 75 becomes 100, meaning it increases by 25,000. Depreciation reduces the PP by 20,000. Right. Tell me what's the total here. Quickly tell me the total here. What's the total? 180 minus 60 is 120. 125, right? 125,000 is the amount, right? But what is the closing amount? 250. So what's the difference? What's the difference? Cash has gone out. Okay, there is a cash outflow of 125,000. Okay. But they are saying 50,000 was received for sales of the PPE. So outflow of 125 plus there is an inflow of 50. How much is the net? How much is the net? 75. So cash flow minus activities is 75,000 outflow. Okay. Right. Is that clear? Okay. Next question. West has a 75% subsidiary life and is preparing its consolidated statement of financial position as of 31st December 2026. Okay. Now we are moving into, now we are done with IAS 7. Now we are moving into consolidation. From this point onwards, we are moving into consolidation. Okay. Right. So here they are saying West has 75% subsidiary life and is preparing its consolidated statement of financial position as of 31st December 2026. The carrying amount of PPE in two companies at that date is as follows: 360. On 1st January, Life had transferred some property to West for 40,000. Life transferred to West for 40,000. At the date of transfer, the property which had cost 42,000 had a carrying amount of 30,000 and a remaining useful life of 5 years. Carrying amount of 30 but sold given for 40. So there is a profit, right? How much profit have they made here? How much profit have they made here? How much profit have they made here? So there is an unrealized profit that needs to be removed, right? So we need to remove the unrealized profit. Okay, right. How many of you all are familiar with this? Tell me. If you're not familiar, I'll quickly take you all through the tutorial note as well, because this is very uncommon, but something that can be tested, that has been tested. Okay. How many of you all are clear with this? How many of you all want me to take you all through the tutorial note for this? Okay. Let me take you all through the tutorial note. Give me a moment. It should be in this. There we go. Right. So now when it comes to intra-group sale of non-current assets, what happens then? So here there are instances when one company or one intra-group company sells to another company. Now we've seen that in terms of inventories and we are very familiar with that, right? No problem there, and we know how it works, so we can get it done. When it comes to asset, there can be sales of assets as well. Now there we need to be a little bit particular, right? So when one group entity sells non-current assets to another, adjustments are required to reflect the situation as if the sale had never taken place. there would have been no profit from the sale. Depreciation would have been based on the asset's original cost. That's what you have to do the adjustment based on. Whatever profit was made, whatever post depreciation, not your problem. You have to make it look like the asset was never sold, no profit made, and the depreciation was based on the past, the original cost itself, the past cost is itself, right? So any profit made should be eliminated similarly to inventory. However, non-current asset transfer within the group may remain in consolidated statement of financial position for several years, right? Okay. So how do you calculate the PUP? Okay, so you are going to do a comparison between with transfer and without transfer. It was small comparison table, right? With transfer, what's the carrying amount at date of transfer? Without transfer, what is the carrying amount? Depreciation based on the transferred amount, depreciation based on the original cost. Then we see the difference. The difference is what we are going to adjust. So what we do, deduct the net PUP amount when consolidating the non-current assets, deduct the profit from the sale from the selling company's reserves, right? Subsidiary, if subsidiary has made the sales, then in working 2, if parent has made the sales, then working 5. Add the difference in depreciation, excess depreciation charged to the buying entity, to the buying company's reserves. So difference in depreciation will need to be added to the buying company's reserve. If subsidiary is buying, then you add it to working 2. If parent is buying, then you are adding to working 5. The adjustment to subsidiaries reserves in working 2 will affect the post-acquisition profit. This adjustment will be shared between parent and non-controlling interest. Okay, that's a tutorial note. Let's go back. Let's look at this question. Okay. Now tell me, when we are doing the comparison, we need to do 2 comparisons, right? We need to do 2 comparisons, right? Now here, what's the new amount? Let's put it on Excel itself, right? With transfer, without transfer, right? With transfer, what's the carrying amount? What's the carrying amount with transfer? 42,000, right? 40,000. Yeah, carrying amount transferred to waste for 40,000. What was the amount, carrying amount without transfer? Without transfer, what is the carrying amount? It is had a carrying amount of 30,000. Okay. Now they are saying, and a remaining useful life of 5 years. 30,000 and a remaining useful life of 5 years, right? So 42,000 becomes 30,000. So it was 42,000 that became 30,000, right? Meaning 12,000 have already been deducted. Now the 30,000 has a remaining useful life of 5 years. So 30,000 divided by 5, what's the answer? 30,000 divided by 5 is going to be 6,000. Yeah. So depreciation. Let's look at the depreciation. So here it's going to be 6,000. What will be the case here? 40,000 divided by 5. That's going to be 8,000. So tell me the carrying amount. So what's the carrying amount after depreciation? What's the difference? What's the difference? Okay. Do you get the difference? Now what you have to do is, this is the PUP. This is the PUP, the unrealized profit of asset, non-current asset transfer. So you need to eliminate this. So what do you do to eliminate? You add the parent's NCA, you add subsidiaries NCA, and you eliminate PUP. What's parent's NCA? 300,000. Subsidiaries NCA? 60,000. And what is the PUP? 8,000. So what's going to be your total? This plus subsidiary and eliminate So what's the amount? The carrying amount of property, plant, and equipment is 352,000. Was that clear, guys? Was that clear? Or was it confusing? With inventory, you all are used to.
75%
The other one, that's going to impact your P&L mainly, and this your retained earnings sections. The 75%, 25%. Okay. Right. So now you know how to do a non-current asset transfer based PUP. Okay. Now why? Okay. Now the purpose why I have selected these questions for the revision. Now whatever questions I've chosen are little different, a little unusual. So why I've chosen this is so that at this point you do it, you are familiar with that. Okay. So you don't be surprised when you see such a question in your paper. Are we clear? Are we clear? Right. Moving on to the next question, 157. Harry acquired an 80% holding in Style on 1st April 2086. 80% holding. From 1st April 2086 to 31st December, Style sold goods to Harry for 4.3 million at a markup of 10% markup. Harry's inventory at 31st December included 2.2 million of such inventory. The statement of profit or loss for each entity for the year to 31st December showed the following in respect of cost of sales. 14.7, 11.6. What is the cost of sales figure to be shown in consolidated statement of profit or loss? Okay, cost of sales. What do? Parent plus subsidiary apportioned minus intra-group sales plus PUP. You all know this formula? This formula you are familiar with, right? So what would be the case here? 14.7 million. Subsidiary was acquired on 1st of April, 31st December is when they are asking. So April, May, June, July, August, September, October, November, December. Subsidiary's performance is accumulated for 9 months, right? So that's going to be 11.6 into 9 over 12, right? Then there is intra-group sales. What's the intra-group sales value? 4.3 million. 4 minus 4.3, right? So it's 14 point. Let me clearly write it here. 14.7 plus 11.6 into 9 over 12 minus 4.3. Now we need to figure out what is the PUP. How do we figure out the PUP? How do you figure out the PUP? So we know it was done at a markup of 10%, right? Right. So it is done at the markup of 10%. Right? So they are saying 2.2 million of such inventory remains. So the profit that you want to search is for that 2.2 million. So 2.2 million into markup of 10%. Tell me what's the answer. What's the answer? It's 200, meaning it's 0.2 million. So that is our PUP plus 0.2. What's the answer? 19,300. Lakshmita. Lakshmi, there was a question that you sent and you have unsent it. Okay. Right. Next question. Heel acquired a 60% holding in SOC on 1st January 2086. At this date, SOC owned a building with a fair value 200,000 in excess of its carrying amount. Now comes the fair value adjustment. And remaining life of 10 years. All depreciation is charged to operating expenses. Goodwill had been impaired by 55,000 in the year to 31st December 2086. The balances on operating expense for the year to 31st December 2087 are shown below. Right. Now there is a fair value adjustment. What's a fair value adjustment? 200,000. So 200,000 with a remaining useful life of 10 years. So what's the depreciation relevant? 20. So we know we are supposed to add 600 plus 350 plus 20. How much is that? 970. Now it says 970,000. 970,000. Okay, we ask here we add the depreciation to our operating expense. We don't deduct. Okay, it's 970,000. Clear? Right. Next question. A acquired a 60% holding in B on 1st July 2026. At this date, A gave B a 500,000 8% loan. The interest on loan has been accounted for correctly in the individual financial statements. The total of finance costs for the year to 31st December in the individual financial statements are shown below, 270. So this is the total of finance cost. Right. So 500,000 8%, how much is that? 500,000 into 8%, tell me. 40. So what you are supposed to do? What are you supposed to do? You're supposed to eliminate, right? Eliminate the amount of interest. Okay. So this is going to be for how many months? 1st of July 2026 to 31st December. So 40 into, how much is that? That's 20. Okay, that's 20. 500 into 80% is 40, right? Yeah, fine. That's 40. Okay. So now what are you supposed to do? You are supposed to add 200, right? Plus the 70 finance cost. You'll have to eliminate the 20, right? So here it is 50,000, right? So if you remove this, it's 50,000. 70 minus 20 is 50,000. So you are adding 50,000 into 6 over 12. How much is that? Why we are portioning the subsidiary? How much is that? 225. Okay. The apportionment we did here was for the finance cost because loan is going to be for 6 months. This apportionment is for subsidiaries addition. Subsidiaries overall cost.
Down where are we putting 0.7?
Hmm?
Down where are we apportioning?
What is this apportionment?
That is for finance.
That's a finance interest. Now loan was given. So subsidiary is supposed to pay loan or interest on loan. So how much will subsidiary pay for the loan in the 6 months? Only for 6 months, right? So first we identify what's that figure. Then we remove that figure from subsidiary's amount. So that becomes 50,000. Then 50,000 is the total for 12 months. So we only take for 6 months as subsidiary. Right? So that's total cost. So we take only for 6 months. This apportionment is the loan apportionment, loan based interest apportionment. This is the subsidiary based apportionment. Clear? Right. So that's 225,000. That says B. How many of you got that right? How many of you got that right? Next question. Burridge bought 30% of Allen on 1st July 20x4. Allen's statement of profit or loss for the year shows a profit of $400,000. Allen paid a dividend to Burridge of 50,000 on 1st December at the on 1st December 20x4. At the year end, the investment in Allen was judged to have been impaired by 10,000. Allen 30%, so that makes it an associate. Follows equity accounting. The equity accounting is going to be based on the cost, and if you take P&L SFP, it's going to be the cost and the post acquisition profits. If you take the consolidated statement of profit or loss, you take only the post acquisition profit. So what's the post-acquisition profits here? So they have made a profit of 400,000, right? First July to December, first you time portion the total profit. How much is that? 200,000 into 30% is going to be relevant to us. So how much is that? 60,000. From this, we have to deduct the impairment. How much is that? We deduct the impairment. So this is Alan. The investment in Alan was judged to have been impaired. Alan's investment that we made there was impaired. So the answer is B. Are we clear?
We have put in 60,000, right? Okay. Right. Then 10,000 must be also associated with 30%.
No, that's what I'm saying. So investment in Alan. So this is the investment that's impaired, not the associate. Associate is not impaired, but my portion of investment is impaired. So there the it's taken as my proportion itself. If they say total impairment loss in the associates P&L was not considered, then you deduct that and multiply by 30. If they are clearly saying the investment was impaired, then it is only your portion that's impaired. So they're giving you your portion itself as an so. Okay, so you just take that. Okay. Dividend, we are going to adjust it from our income, right? So when it comes to now, if we look at the dividend, it is going to be recognized in our income, but it's a cost side of which you remove. So cost is not going to be shown here. Okay, so dividend income cost is not going to be shown here. A quick tutorial note on that. Right? So investor share of profit for the year is shown as share of profit of associate less any impairment in the year. That is going to be considered above profit for the year. So what's the question here? What will be the share of profit from associate? If you take Burridge's P&L, right? P&L. Now they are just asking the share of profit from associate, no? So that is 50,000. But under Burridge in interest income, or dividend income, investment income rather, not interest, investment income section of Burridge Co, they would have recognized the dividend of how much is given? 50,000. So you will have to eliminate that from Burridge's account. So here what they are asking only the share of the profit. When dividend is paid, do you think that it is going to be shown in Alan's P&L? No, Alan's dividend, when Alan pays a dividend is a reserve transfer. That's going to be in SFP. It's a dividend is paid after the retained earnings, right? So there is nothing that's done in SPL, so that is not going to impact your associate share. But if they had asked what would be Burridge's total SPL adjustment, then it's going to be that you add the share of profit from associate and you deduct the dividend. Clear? Are we clear? Is that clear? Right, perfect. So this is from associate share perspective only. We only consider share of profit. The question asks only for share of profit. Had they asked a total requirement, then you would have eliminated dividend also. Alright guys, let's take a 20 minutes break. It's 4 doing the last 7 questions. Okay, let's do the last 7 questions. It's 4:25 approximately right now, so get done by 4:50. Okay, 25 minutes. guys. Are you done? Just giving you all 2 more minutes. All right. Shall we? How many questions done? Why? Huh? Why is that? Okay, fine. Bson bought 30% of Arnie on 1st of January 20XA. 30% of Arnie meaning that's an associate again. When Arnie had share capital of 100,000, $1 shares and 400,000 retained earnings. So 400,000 was the retained earning, 100,000, $1 shares, 500,000 total net assets. The consideration comprised 1 Bson share for every 3 shares bought. Now that's interesting. We've seen share exchange when purchasing subsidiary, but we have not seen share exchange when purchasing associate. So this question does exactly that, right? At the date of acquisition, Bson shares had a market value of 4.5 and Arnie's had a market value of 2. On 31st December, Arnie's net assets were 460 net assets. So total net assets. Okay, fine. Let's come to that. There's a trick here. I hope you all have figured that out. So let's come to that. Okay. 30% of Arnie's share capital was bought, right? So that's going to be 30% of 100,000 shares, right? That's how much? 30,000. So paid consider comprise share for every 3 shares. 1 Bson share for every 3 shares. So 1 Bson share for every 3 shares. So how many shares were offered? They offered 10,000 shares. What's the market rate? 4.5. So what's the investment value? 45,000, right? Then comes the post acquisition. Is it a profit or a loss? Is it a profit or a loss post acquisition? Someone tell me. How many of you all? Okay, raise your hands if you see a profit there. Raise your hands. See a profit. Raise your hand if you see a loss there. There are 4 of you thinking there is loss. The rest of you all, do you all see a profit? Okay. Now you see 460,000 is net assets. Now here they've made it tricky by giving you net assets broken down into 2 sections. 400 plus 100 is the total net assets, right? So that's 500. 500 becomes 460. So there's a loss of 40. 40,000 loss into 30%. How much is that? 40%. 40,000 loss into 30%. How much is that? 12,000. So this minus 12,000. How much is the value? What's the value? 33,000. Right? Okay. Platinum Co. acquired 80% of the ordinary share capital of Palladium Co. on 1st April 20x0 year end. Okay. No need of year end because they are no cash consideration. By means of cash and contingent consideration. At this date, Platinum Co. assessed the fair value of contingent consideration at 250. Platinum Co. calculates non-controlling interest using fair value at the date of acquisition, which was estimated to be 100,000, and the goodwill arising on acquisition was 300,000. The following figures for Palladium Co. are relevant. Ordinary shares 500, retained earnings 300, profit for the year 120. The profits for Palladium Co have accrued evenly throughout the year. Okay. Now what you're supposed to do is you are supposed to do a reverse calculation. They've given you the goodwill. You have to find the cash considerations. Of course, you are going to do a reverse working. Right. What's the formula for goodwill? Quickly tell me the formula for goodwill. Formula for goodwill is going to be cash consideration. So first it's consideration. Then the contingent consideration. Now that's going to be our consideration. Then NCI. Then we have minus fair value of net assets, right? Fair value of net assets. Now, what's the NCI? Have they given the NCI? What's the NCI figure they've given? It's 100. What's the contingent consideration? 250. And what's the fair value of net assets they've given? They've given ordinary shares, retained earnings, share capital, retained earning, and profit for the year. Okay, when did the purchase happen? 1st of April. Year end is 31st December, right? So out of this, 1st Jan to 31st of March is free acquisition. Okay, because 1st of April is where they've purchased it. Now there is a small apportionment you'll have to do here. 120 to 3 divided by 12. So that's going to be 30, right? 30. Okay. So now we have the profit accrued up to acquisition date. 30. Retained earnings we know was negative 300, a loss. Share capital we know is 500. Right. How much is that? Right, 230. Okay, let's do the calculation here. 230. Right, and they've given the goodwill figure 300. Now we do a reverse calculation. How do we do reverse calculation? We add what has been deducted and we deduct what has been added. 300, 230 minus 100 minus 250. That's your cash consideration, 180. Okay, the cash consideration is 180. Is that clear? Is that clear? How many of you have got that right? How many of you have got that right? Great. Okay. Then we move on to the next question. PACT acquired 80% of the equity shares of SACT on 1st July, paying $3 for each share acquired. This represented a premium of 20% over the market price of SACT. Right, SACT shares at that date. SACT's equity at 31st March 20x5 comprised, whatever details are given. Okay. The only fair value adjustment required SAC's net asset on consolidation was a 20,000 increase in the value of its land. Tax policy is to value non-controlling interest at fair value at the date of acquisition. For this purpose, the market price of SAC's shares at that date can be deemed to be representative of the fair value of shares held by the non-controlling interest, right? $3 was what was paid, which was at a premium, right? Premium of how much? 20%. That's going to be $3 into 100 divided by 120. Now this 120 is what they're saying. This is 120%. So we have to take 100%. So that's going to be how much? 2.5. Right. That is 20% is the NCI, 20% of the equity share. So equity share capital is 100,000. 100,000 into 2.5. How much is that? How much is that? First July they purchased. So 9 months performance is added here. July, August, September, October, November, December, January, February, March. So there's a 9-month performance that goes in here. Okay. 50,000 is the, now this is working for that we are doing of SFP, right? Then we have to add the post acquisition movement in your reserves. So what's the post acquisition movement here? Retained earnings at 1st of April 20x4 was 80,000, right? 1st of July was when they purchased. Profit for the year ended 31st March was 40,000. Now this 40,000 will need to be apportioned. Tell me how much is that? 40,000 in 9 over 12 is how much? So that's a post acquisition component. 3 months is relevant to pre acquisition. 30, right? 30. Now 30 into 20%. How much is that? 20%. That's 6. So we add the post acquisition reserves to the NCI, and that gives us the NCI as at the year end. There we go. Okay. Right. Then the next question. On 30th June 20x4, the Winter Group disposed of its 70% holding in the ordinary shares of Spring for 9 million in cash. Now it's a disposal. Winter Group disposed 70% holding in the ordinary shares for, of Spring for 9 million in cash. 9 million is a cash proceeds. Winter originally purchased the shares for 6 million. 6 million was the original purchase price. Okay. At the acquisition date, the goodwill was $4.6 million and has not been impaired. $4.6 million not been impaired. Spring's net assets at the disposal date was 5 million. Non-controlling interest in Spring at the disposal date were 3.1 million. So is this relevant to you? Is this relevant? That's an additional unwanted line in the question. What is relevant is going to be the 9 million proceeds, and you have to eliminate the goodwill. You need to eliminate the net assets, and you need to eliminate the you need to consider the non-controlling interest part removed, right? Okay, how do you do that? 9 million proceeds minus 4,600. Now this includes NCI's goodwill component also. Net assets 5 million, that includes NCI's component of goodwill also. Therefore you remove the NCI. Okay, so what's going to be the answer? What's going to be the answer? 9 million minus 4.6 minus 5 plus 3.1 is 2 500. So that's 2.5 million. Okay, that's 2.5 million. Right, with that we are done with consolidation. Now we are moving into ratio analysis. Return on capital employed. What's the formula of return on capital employed? Return on capital employed formula is going to be your profit from operating profit divided by debt plus equity. That's your capital employed. Right. What's the operating profit? 980 minus 530 minus 210. How much is that? 240 Divide by debt plus equity. Debt is how much? 300. Equity is 600. So how much is that in total? 900. So what's going to be our ROCE?
0.2666.
So it's 26.7. Right. Then question 195. Marcel has calculated that its current year price earnings ratio is 12.6. The sector average PE ratio is 10.5. Which of the following would be an explanation of the difference between Marcel's PE ratio and sector average? Marcel is seen as a less risky investment than the sector average, and there is higher confidence about the future prospects of Marcel, number one. Then Marcel is seen as a more risky investment than the sector average. However, there is higher confidence about future prospects. Marcel is seen less risky, more risky. Okay, first tell me, higher PE ratio is good or lower PE ratio is good? No, ACCA deferred tax will not be added to debt. Debt meaning long-term debts. No, deferred tax won't be added there. So only the debts will be added there. Okay. Tell me PE ratio. Higher the better or lower the better? Higher PE ratio is better. Higher PE ratio means that indicates this company's the price of share is low in the share market while they're performing better, meaning the future prospect is high. Right? Their future growth is expected to be higher. Right? So higher meaning they are indicating they are less risky because their future prospect is strong. So higher than sector average meaning Marcel is seen as a less risky investment than sector average. And there's a higher confidence about the future prospects. Okay. Why? Because PE ratio looks at what is the current price versus the earnings per share, and based on that it decides how much are we deviating. So if the higher the deviation, better it is, right? Higher the PE ratio, better it is. Okay. Right. Then the final question for the day, or for the Power 50, right? Apollo took out a new loan on 1st January 2026. This loan carries an effective interest rate of 8%. The initial proceeds of the loan were 2.5 million, which is after paying issue cost of 250k. The coupon rate on the loan is 6%. Apollo must keep to an interest cover ratio of 9 times under the arrangements made with the bank. 9 times at the arrangements made with the bank. So here they are saying it is after paying issue costs. So 2.5 million is already considered the issue cost component, right? So they've already, so you disregard that because it's after paying. So 2.5 million, you take 2.5 million and you have to multiply by the interest rate of 8%. How much is that? Now don't get confused here. You don't use coupon rate. Here you use effective interest rate. How much is that? 200,000, right? Interest cover ratio of 9 times. Interest cover ratio of 9 times. What does interest cover ratio say? How many times can you pay interest out of your current earnings? Profit before interest and tax. Okay, tell me. Is it profit before interest and tax or profit after interest and tax? Profit before interest and tax. Why? Because you're trying to figure out how much interest you can pay, right? After deducting interest, it's useless. So before you deduct interest, you figure out what is the interest cover. So PBIT, or you call it operating profit over interest or finance cost, right? Now this is what it gives you your finance or interest cover ratio. Now interest cover ratio 9 times meaning, okay, now this finance cost they've given 200,000 into 9 times. That is what you'll have to maintain as your PBIT minimum. So what's that going to be? 200 into 9. How much is that? 200 into 9? 1,800. B is the answer. So knowing the formula, now you see these questions are where they're not asking straightforward formulas. Rather, they are giving you the answer and you have to work backwards. So you need to know the formula clearly. Okay, no chance of not knowing the formulas. You can't be confusing PBIT with profit after tax, right? When it's return on capital employed, it's PBIT. Return on equity, it's profit after tax. All that I have explained clearly why not in the lectures itself, the last lecture, analysis lecture. So just try to maybe, if time permits, watch that. Okay. All right, guys. How many questions did you all answer right? Quickly throw me your answers. How many answers did you all get right? Quickly tell me, out of 25, where do you all stand? Out of 25, where do you all stand? Brilliant. That's brilliant, Lakshmita. The rest of you, quickly tell me, where do you all stand? Okay. Not bad, Ilma, but you can need to work a little bit more. Very good, Sajitan. Very good, Asya. Very good, Siddhamini. So we have Lakshmika at the highest right now. Very good. Okay, the rest of you, Shakil, Akif, what happened? Where are you? Sleeping. Sleeping. Shakil, Akif, what were your marks? Quick to tell me. Okay, I think Shakil and Akif are sleeping. The rest of you, I don't receive answers from all of you, so I want all of you all to respond. Anyway. So anyone who scored above 15, great. You are at a good, you have prepared well, because these have been tough questions I've taken, right? So above 15, good. Below 15, if it's above 12, meaning you had 50%, so that's, you need to work a little bit harder. Above 15, you need to, maybe work a little bit more. But those who have scored 17 and higher, right? Very good knowledge. Okay. So keep practicing, keep learning, know all the nitty-gritties of standards, right? All the one-page summaries I was doing in the classes with all the standard, right? Either before the standard started or after the standard, I used to do a one-page summary. So try to do the one page, read those one pages. If you don't have, just try to create a one-page summary and try to recall what the points. And if you all have any questions, any doubts, any assistance you all require, please feel free to reach out to me. I am there to help you. Okay. Right. So Shakil, the reason I did not respond to your question was because today we were discussing that question here, which is why I did not respond to your question. Okay. All right, guys. So I'll see you all on next. Okay. Loan is not given as early as No, when they have not clearly mentioned, meaning that's an arrears. If it's advanced, they'll clearly mention it's advanced. Okay. The plan for next week, ACCA, is section C questions. So there are a couple of section C questions I have prepared. I mean, I've taken from the past paper, but I'm not sure if I will be able to do that. So it's past paper that we're discussing. Some good questions. I'll be selecting some really good, really interesting questions. All right. Okay, guys. So I'll see you all on next weekend. Keep preparing, keep studying, keep putting all your efforts, and keep enhancing and elevating the effort that you're putting. All the very best. Take care, stay safe, and have a great week. All the best.